Welcome to The Investor, a podcast where I, Joel Palafinkel, your host, dives deep into the minds of the world's most influential institutional investors. In each episode, we sit down with an investor to hear about their journeys and how global markets are driving capital allocation. So join us on this journey as we explore these insights. Great. So I'm super excited today. Got a good friend of mine, Samir Kumar. He's at Touring Capital. He has a long track record of investing, worked at some really top, well-known investment firms, and has just a really strong career in technology and investing. So, I believe one of the firms he worked at, very prominent investing firm, M13 of Microsoft. So Samir, excited to kind of go a little deeper on your career, your background, why you decided to, launch an investment business, and just kind of want to hear, what was going on in your head, through your just entire career journey. So excited to kind of just go deep on maybe stuff that you normally don't go deep on, just reflecting on your career, your education. And, sometimes it's important to do that, just kind of take a step back and think about your journey and think about maybe what your purpose is, like what's the point of all this, right? We're launching a fund, we're launching a business. Hopefully we do well, but in the end, what is the actual the vision and kind of what's the end game? So let's start from the beginning. Tell us about maybe your family, your early career. What did you study? What did you want to aspire to be when you were younger? And did that change, or did it just kind of stay on track to what you thought you would do? For me, I thought I wanted to be an astronaut, and I think at some point I wanted to be a fireman. And in some instances, there were some directional alignments with those things. Working for the DoD, working in aviation, but it's not about me; it's about you. So let's have you talk about your story.
Yeah, thanks, Joel. Thanks for having me. Excited to talk to you. And just one quick correction, because a lot of people do make this confuse the two funds. So M13 is actually a separate fund. I think they're based in San Diego. And M12 is the fund that I was at, which is Microsoft's venture fund.
Thanks for the correction.
I just wanted to set the record straight on that. But, if I go back to my journey, like you, I wanted to be either a pilot or an astronaut all the way through high school, even after high school. So I went to Cornell to do my undergrad in mechanical and aerospace engineering. But even there, I was curious and keen on, hey, maybe the path to becoming a pilot is joining the Air Force. So I did 2 years of ROTC. I volunteered. It wasn't something where they were giving me a scholarship, but I believed that maybe that was going to be the path for me if I wanted to be an aviator. And perhaps that's the path I should explore. I think at the end of my sophomore year, I realized that the commitment that you're making is much larger than just, hey, I want to be a pilot. And sure. I think I had to do some soul searching if that was the commitment that I was ready to make at that point. So I did step aside from ROTC, but continued my engineering studies. So I finished Cornell in 2000. My career, frankly, has been a series of experiences versus having some kind of roadmap there. I know exactly where I want to be from 5 years from now, and I'm just working backward from that and how I'm going to get there. When I started my career, I landed at Microsoft completely by chance. On-campus interviews, I signed up. I was a mechanical engineer. I was never expecting to go work for a large software company. But the interview was very interesting. It, definitely tickled my brain in terms of the questions that they were asking. And I think the interviewer felt the same way, that, hey, here's someone who's not a computer science major, but has the ability to think deeply about problems and think on their feet. And so, in reflecting back on that, I think Microsoft was interested in hiring smart kids who could adapt, who could learn new things and think on their feet. And so I really admired and appreciated that. And so I started my career at Microsoft back in 2000 in Seattle, Washington. Originally, I was closer to the sales side of the house. So I cut my teeth on pre-sales, sales engineering, learning the kind of the lingo as well as the lay of the land, and working with Microsoft's largest Fortune 500 customers. At the time, companies like Packard, Boeing, Weyerhaeuser, that were the big accounts in the Northwest region. I did
What
that.
products were you selling? Was it like office products?
No, so it was Windows Server, it was Active Directory, it was SharePoint. So it was, Microsoft's kind of
Yeah.
big iron back-end server products. So
Was
really
this when
understanding.
Satya was there? Because Satya really had a huge renaissance with just the cloud and innovation and connected devices and all that. So were you able to see some of that stuff as well, that
So this
transition?
is pre-Satya. So this is
Oh, wow.
2000. Steve Ballmer had just taken over as
Yeah.
CEO of Microsoft from Bill Gates. And so this is still the era of, Microsoft Windows and Office were the two most important products for the company. Frankly, it was about shrink wrap software. Cloud was maybe a twinkle in someone's eye at that point in the far future. But for me at that time, the big revolution that was very at the beginning of starting was mobile and smartphone computing.
Yeah.
And I still remember the first time I got my hands on a compact iPack, the first pocket PC back in 2000, the shiny thing that frankly looked like a tricorder from Star Trek. And I was fascinated by it. And I think very early decided that if I'm going to go do anything next in my career, I want to be involved with this particular technology and wave. And so the next step for me after starting in sales engineering at Microsoft was figuring out how do I get involved in the product side of building Pocket PC and Windows Phone. And so I made my way to becoming an enterprise product manager in the Windows Phone, the Pocket PC team at Microsoft. And from there, I went on to collaborate with other product managers and engineering teams, and kind of landed in a product planning role because my peers and colleagues say, hey, this is probably the place that you will be the most excited, get the most satisfaction, given your interests, given where you like to lean in. Went on to become a product planner, had a small team planning different kinds of enterprise mobility propositions at Microsoft. And then I would say it was probably starting in 2008, about a year after the iPhone had come out. It started to dawn on me that knowing the internal roadmaps, the internal trajectory of what Microsoft was doing in Pocket PC and smartphones, that the likelihood of being able to successfully be the largest player in the market was dwindling very quickly. And the iPhone and iOS was an impressive product. And I frankly wasn't convinced that we were on a track to be able to compete head on. Around that time, I got to see what Palm was doing with the Pre, which was a big offering, and the company was trying to reinvent itself. John Rubenstein coming in as CEO. One of my former managers at Microsoft had taken a senior leadership role there as well, and was asking if I wanted to come and join. And I was intrigued, and I said, well, maybe the Palm Pre has a shot of beating the iPhone, because if not Pocket PC. So I joined Palm. I got to do enterprise product management on WebOS for a short while. Got to meet amazing people that went on to become leaders in Android, in other device programs and mobile OS companies, and amazing set of innovators and thought leaders. But if you think about Microsoft as a company and Palm as a company, I got to see firsthand. You go from a company that has a huge diversity of offerings across many different product lines to a company that's got all its eggs in one basket. And if that product does not succeed, it's lights out for the company. And unfortunately for Palm, the Pre did not perform as expected in the sales side. So I was only there for, I would say, about 6 months and decided that maybe this is not for me. I joined Samsung to do partnerships on Android. And that was a great experience in terms of kind of the first step in building my network in Silicon Valley across VC, meeting some great entrepreneurs. I still like to tell stories of the first time I met the founders of Siri before they were acquired by Apple, having them present and pitch to senior executives at Samsung to see if there was an opportunity to partner on the Siri side. I got to meet the creator of an application called WordLens, which got integrated into Google Translate as a visual augmented reality feature. And I still remember the first time you see that demo and you think back to like 2010 and seeing a real-time AR demo of translation on a phone and how amazing it was. I still remember I got to meet Daniel Gross back in when he was like 19 years old and still working on his on-device search startup before he'd sold it to Apple. So great experience in terms of looking at the innovation landscape in mobile, in terms of what was happening in the startup community.
Samir, what year was that?
So this was from 2009 to 2012.
Okay. Yeah, so that was actually a good time. I have a few thoughts on mobile. I had some mobile experience as well. So just a few thoughts on BlackBerry, right? So I don't know if you saw the BlackBerry movie on Amazon. It was actually really good.
Yeah.
I forgot the name of the movie, but it was portrayed really well. I mean, I didn't really know the complete story, so it was pretty helpful for me. And then it was just really interesting to just see how you can get comfortable and feel that you have the entire market share. And then Steve Jobs gave his presentation of the iPhone, and design became important, and kind of the way that people interact with devices became important too. So for me at that time, I think definitely, like, I was around when the first iPhone came out, and when that presentation happened. But professionally, I was working in product management, building a lot of mobile web iPad apps that were kind of converging. And I would say on the design side, you got to really think through the information architecture, right? So like on a phone, you probably need more of a high level summary of information. And, some of those devices, I remember really clearly, some devices have a back button where, like, some Android, some Blackberries are an actual Android device, so they don't have the button and it's kind of touchscreen. So what do you do with that, right? How do you integrate the back button? How does the back button work with the App Store? So definitely that was one thing with BlackBerry, just kind of getting comfortable and not realizing or embracing the innovation. I think they tried to have a couple smart devices or maybe just build on top of Android. But I would say, this is kind of where I think slowly the edge of the resurgence of continuity in work life is important, right? So especially in the asset management industry, I used to build a lot of software for the buy side, and like a lot of times when you think about, as a product person, you're thinking about the user journey, right? You're a buy side equity research analyst. Maybe your coverage is oil and gas. So they're looking at the news, and then they're also looking at their holdings. And then, they go on travel, they're flying somewhere, they want to read the earnings reports and kind of read all the research about what they're doing. So there needs to be some continuity from maybe their Bloomberg terminal to their iPad. And then, when they get up, they're probably like, refreshing to see what's happening in the news. And then I think there was I don't know which device it was, but there was this one crazy device where, like, you plug it in like a holster and then it kind of syncs with your screen. I don't know if that was a Microsoft device as well, but that was just one more point I had where, like, the continuity, where, like, it's not really about work-life balance where you shut off at 5 p.m. It's kind of like what Jeff Bezos was saying, where there's work-life harmony, right? Where, like, maybe when your kids are going to bed and, it's 9 p.m., it may be okay to pop in and see something and maybe not do anything that night, but kind of make a mental note to be like, oh, maybe I should send an email in the morning, to kind of just make sure you're more productive throughout your life.
Yeah. No, you're hitting on some really interesting points that I forgot to make, which is when I was at Microsoft and working on Pocket PC and Windows Mobile, I was the BlackBerry rim compete guy at Microsoft.
Oh, wow.
So it was my responsibility to understand BlackBerry inside out.
Mm-hmm.
Now I was the one guy, or maybe one of two guys at Microsoft, walking around with a BlackBerry device, and then later on also iPhone, because I felt it was important to understand the competition. But I really focused on BlackBerry Enterprise Server and what they were doing on the back end and the network side, and where were the gaps for Windows Phone. But I think your point is spot on, which is, it's not about work-life balance. It's understanding that you're one person, right? You're doing work stuff on your phone. You're doing personal stuff on your phone. You don't want to live a completely disjointed life where these things have no connection between them. Of course, your IT department wants to really isolate all the data and the work-related stuff and protect that. But how do you do that in such a way that the user experience is consistent and something that delights the user versus annoys them? So if you think back to the early days, now we all take it for granted. You have a pin on your device when you turn it on or you unlock it. But I still remember having these conversations with other Microsoft employees and engineers when we were advocating for, hey, at a minimum, we should have a device lock on Pocket PC, right?
Mm-hmm.
When people turn it on, they need to put in a pin to be able, and have some kind of enterprise policy that can be managed centrally from IT. This is part of the reason IT departments have accepted BlackBerry Enterprise Servers, because of the controls it's giving them. I think there were like 600 knobs or dials that they could turn in terms of what you could do to control someone's device. But the reality was that most IT departments maybe use 10 of them. But the fact that they had this console, they had this ability to say, yeah, we gave BlackBerries to all of our execs, but we can blow them away or wipe them out, or we can lock them, and we can do that remotely. That was one of the reasons that IT departments actually were accepting of BlackBerry back then, despite other issues with the architecture. But also, I think, when you go back to that time, I still remember having these conversations with senior folks at Microsoft. We were advocating at that time. So if you go back, this is like 2005, 2006, maybe 2007. And hey, the world is going to move to a world where it's not just push notifications for email. It's push notifications for everything, for your line of business applications, your consumer apps. And we need to start thinking about infrastructure for how you efficiently push information to these devices that are on these wide area networks that are not inside of the enterprise, and do that securely. And frankly, at that time, that was not like, oh yeah, that makes complete sense, and of course we have to do this. For a lot of very smart, very senior people, you had to spend a lot of time explaining to them that this is where the world was headed. Now, Joel, you know this as well as I, timing is always the hardest thing to predict. You and I can say this is for sure going to happen. We can say with less certainty if it's going to take 2 years or 3 or 4 or 5. And so maybe we're a bit early. I think now, if you think about where we are with push infrastructure and services on any platform that we use, and you expect notifications, it just took a while, right? And so in 2005, 2006, maybe it wasn't as obvious, but it exploded onto the scene. So yeah, so that was my journey at Microsoft, at Palm, Samsung, doing Android partnerships, building a great network, and right around I would say it was 2012, I got connected with my partner at Turing, Nagraj Kashyap, who was the head of Qualcomm Ventures, was also leading all of the business end of Qualcomm research, because both of the organizations reported up to the CTO at Qualcomm, and there was an opportunity to come join his team. And I think the original impetus was some ideas around what they were doing in augmented reality at that time, but I think they were looking for something broader. We were just on the cusp of AI 1.0, the big deep learning revolution that happened with the ImageNet breakthrough. Yeah. So it was my time at Qualcomm where I went down the rabbit hole of deep learning and neural networks and AI, and frankly have never come out since. I've been interested in other areas, but this has been a consistent theme in my career. Whether it's on the operational side and kind of business and product roles, or it's on the investing side, Qualcomm Ventures, M12, it's been a theme now for over a decade. And so, having seen kind of the waves of AI 1.0 back in 2012, let's call it AI 2.0 in 2016, 2017, when every company was rebranding itself with a .ai. And then obviously, the third wave that happened once we saw these large foundation models and ChatGPT explode onto the stage. So Qualcomm was, 5 years, great experience working with the ventures team, helping them form their thesis on AI investing, also working with the research side in how do we commercialize some of this research that we're doing, and really amazing work in on-device machine learning, indoor location services, parallel and heterogeneous compute architectures that run on phones, not just in the data center. So a great portfolio of tech. And I think I got to experience, the ins and outs of how easy or maybe not easy it is to commercialize research in large companies and bring it to market, whether you commercialize it through external partners like startups, or you bring it through your own product and commercial organizations and bring it to market. Whether it's Microsoft, whether it's Qualcomm, whether it's Google, it's never easy. But I think, you have to be thoughtful about the approaches that you take and the push and pull of where you lean on to be able to make things happen. I think lots of learnings there. And then it was in 2017, I think about a year and a half after my partner Nagraj had left Qualcomm Ventures, had been recruited by Satya to come and start officially Microsoft's early stage venture practice. It was still called Microsoft Ventures back then, before we'd rebranded it to M12. So he gave me a call in 2017, said, look, we're going through the second wave of AI. You've been very deep in this area. Why don't you come and join us and help us kind of figure out what our strategy is here, separate the wheat from the chaff in terms of who's a .ai versus really has something. And so for me, that was a moment to say, okay, time to go deeper on the investing side. I built a good amount of domain knowledge and expertise in machine learning, AI, and deep learning. So maybe that's the next move in my career. So I joined M12 in 2017, originally with a focus on horizontal AI investing, core AI investments. But I quickly kind of spread my wings to deep tech more broadly. So taking on kind of an investment mandate for, I would say early stage deep tech investing across quantum computing, robotics, AI silicon, obviously AI horizontally and vertically, and other kind of deep tech areas. In a fund that I would say was 80% SaaS oriented, I had kind of I'd like to say I had the best job in the world, where I was doing probably the most fun part of the portfolio. We like to call them the platform shifting bets. And as you know, with all things deep tech, if something pans out, it truly will be transformational.
Yeah.
But a lot of times you don't know about it till it's much more mature. So that's what I got to do at M12, and it was a great ride, a great experience. I really spent a lot more time with Nagaraj there. I met my other partner Priya there. We had an opportunity to work on a bunch of deals together. So I was there for 5.5 years, and then I think it was in early 22, and we had seen a good amount of turnover in the team. Nagaraj had gone on to SoftBank. Priya had originally gone on to Mayfield, and then SoftBank after that. And a lot of other folks had also moved on. It felt like, hey, perhaps it's an inflection
Maybe
point.
It's time for me to move on too, right?
Yeah,
and kind of
right.
figure out what the next step is.
Point.
Yeah.
We built something great, very proud of our track records, top decile fund in terms of returns. But, as you may know, in corporate venture capital, the tides shift, right? So sometimes it can be very independent, financially driven, other times more strategically oriented.
Yeah.
I would say in its current incarnation, and where Microsoft is in terms of its position, I can understand why they're more strategically oriented now than maybe we were back in 2017.
Yeah.
So I got the bug to say, hey, maybe it's time to kind of spin out and do my own thing. Originally thinking about maybe a deep tech fund, but I think, as you know, the fundraising environment was quickly deteriorating in 22, 23. Much stronger focus on DPI versus TVPI from LPs. And of course, as I've learned myself, in a risk-off or less risky environment, wholly new teams that haven't worked together before, don't have a track record together before, becomes a much harder sell for LPs than, hey, this is a team that it's been in a partnership. They know how to challenge each other. They know how to argue. They know how to get along. And so for me, the learning was, hey, there's a better path here to reunite with some of my former M12 partners and end up, doing touring with Nagaraj and Priya versus a wholly new deep tech seed and A fund with people I admire and respect, but I don't have a track record of co-investing with. And so that was the kind of the origin story of touring.
Well, tell me, let's go a little deeper in terms of, because part of company building and team building is convincing people to come on the ride with you, right? So it sounds like the other two people had pretty good gigs, right? They're working at Mayfield, and I forgot where the other one was working at.
Okay, Vision Fund 2.
Yeah, so I mean, to convince somebody, and everybody has different things going on, right? They've got mortgages, they've got 2 kids in daycare, right? So to kind of take that leap to say, you know what, like, I've been kind of working at these franchises for a long time. There's a lot of equity that I've built, but that equity hasn't come along with me, right? That equity has been retained at those franchises, and those franchises are continuing to appreciate those benefits. It's time for me to build something and build equity in myself that could evolve over time and become one of those franchises one day, right? So how did you kind of decide, in terms of the 3 of you guys, to build this together? Was it, one night getting Chinese food together? Was it just kind of something that's been compounding over time? How long has that been compounding? And then how did you guys, tell me the story of like when you guys decided to actually do this?
Yeah. Great question. So I think that I'll answer the compounding one first. So that's really a long arc, right? Because having seen how Nagaraj built Qualcomm Ventures, what we built together at M12, the culture, the approach, the team, I really respect and admire that. And so in the back of my mind, after the changing of the guard happened at M12, part of the thing that I was looking for is how do we recreate something like that? Because I really enjoyed that. It was a work hard, play hard culture, and is there an opportunity to recreate that? Now, separately, Nagaraj and Priya were both at SoftBank, and I think Nagaraj had decided at one point that while the amount of capital that SoftBank has access to is tremendous, and you can be a kingmaker, he also thrives at somewhat of an earlier stage. So not doing like true growth stage, Series C and D. Yes, you can do that, but his passion was a little bit earlier, where there's still some pattern matching that's going on in how you evaluate founders. There's still some information asymmetry. There's still some gut and intuition about which teams you want to place bets on versus not. And so he wanted to get back to doing that. I think both of them originally actually pitched that to Masa and said, hey, could we do a smaller Series B funds, write smaller checks, and do that within the construct of the Vision Fund? That opportunity did not materialize. So I think both of them at that point had decided that, hey, they want to go do that and do it outside of SoftBank. And, I kept in touch with Nagaraj even after he'd left, and I was still at M12. So when he shared with me that was kind of his plan, that he was planning to leave and do his own thing, we said, okay, well, maybe there's an opportunity for us to join up. And so I think we together were then able to identify our anchor investor, which is Oakley Capital, and bringing Nagaraj and the head of Oakley together and having a meeting of the minds to say, this is perhaps somebody that can anchor us if we spin out and do our own thing. All of that came together in the fall of 22. But these conversations probably were starting to happen in some way, shape, or form even earlier, like late 21.
Yeah.
And then, if you were to ask both Priya and I why we're doing touring, a huge part of this is just the respect, admiration, and mentorship we've gotten from Nagaraj over the years. And so the opportunity to join forces with him again to build something that is kind of our own, smaller and independent, was the big appeal.
So, also, you and I, when we first spoke, we talked about the name, right? So, I mean, Turing, when you think about like Alexander Turing, that's Turing.
Yeah.
And you guys are like touring, right? So tell me a little bit more, or just refresh me and share with the audience, what was the motivation behind the name and the branding, and how'd you also think through branding as well? Because I'm going through that exercise now.
Yeah, and branding is an ongoing thing. It's one thing to have a logo. It's another thing to have your brand pillars that are going to be, long-term and kind of how you represent yourself. And that's an exercise we are continuously iterating on. And I think you'll see in probably the next month or so some refreshes and kind of the brand pillars for touring. But as far as, the branding itself, we early on knew we were going to be a global fund. And we're going to be investing around the world. We've done that at M12. We've done that at Qualcomm. My partners have done that at SoftBank. And so, part of the name is we're touring the globe to find the best entrepreneurs. So that's the core of the name.
I love
that. Now, obviously, if you look at the logo itself or the name, you can see the O is meant to represent the world, or kind of a word art to describe, going around the world. But then you can look at the rest of the letters, and yes, there's a name in there, right? And it's Turing. And so that's not necessarily the main message, but for those that are in the know or are in the ecosystem, are involved in the field of AI, it's a little tip of the hat. It's a tip of the hat and an acknowledgement that a lot of this goes back to Alan Turing if you're talking about AI. But the core of our brand, the first thing we want to talk about is we're touring the world to find new entrepreneurs and the best entrepreneurs. And it's not just in Silicon Valley where you'll find those people.
Sure. No, I totally agree. And I mean, I'm going to have a guest on soon. This person has been kind of known in the community for helping some funds really rebrand. One of the funds that graduated from one of my previous fund accelerators, just, noticeably had a really beautiful website, and just completely noticeably different than like all the other websites and collateral. So I was like, wow, this looks like pretty much like a luxury brand. The website, super crisp, super clean, like the color scheme seemed to be really well thought out. So I was like, wow, who designed this? And then I met that person's designer, and it's been probably close to a year, in the process of like rebranding Sutton Capital. But and I'll share some updates as we come along, similar to like how you're doing. But I had to go through this whole exercise of mood boards. So I had to kind of like think about when I think about something, what do I want people to kind of understand about it? What do I understand about what the brand is? So a lot of times, like, there's a difference between marketing and branding. The brand is kind of like, look, you see the Nike check box, you see the Nike check mark, how does that really make you feel? What do you identify with? And I think that's kind of a hard thing to really figure out, because, a lot of times people just need to see that color or like the mark and then already feel some type of emotion. So I think the touring branding, which you're talking about, I do feel kind of like a friendly presence, like you're touring the world, you're going on trips. I almost kind of think about, I sometimes I think about like bicyclists, they're doing these long bicycle tours, but it definitely is like a friendly kind of feeling that I feel. So, kudos to you on.
Thank you. And part of the messaging also is, of course, many firms claim to be founder friendly, but we really, so, pardon my French, but we have a no assholes policy in in touring, which is, founder friendly. And, ultimately, of course, you want interests to be aligned with the startups that you're investing in. But ultimately, we take that very seriously. And then also the culture within the team in terms of why are we doing this? Who are we adding to the team? It truly is a no assholes policy. So I think we take that to heart. And, it also reflects on our anchor investor. They're a private equity firm, and they're also known for being founder friendly in that they don't come in and try to replace the management team. They're betting on the founders that they are buying the companies that they're buying. And that's also, I think that was one of the reasons we had a meeting of the minds. Like, hey, we're a VC fund. It makes sense. We're going to be betting on founders. But our biggest partner has the same mindset in terms of when they're acquiring companies.
Yeah. And I mean, what's important for everybody to realize is, VCs and private equity investors that are building something, they're founders too, right? So your anchor is essentially betting on you as well. And, I think one of the things that you hit, which kind of helps to mitigate some of the risk, is obviously just the ability to do the exact same thing that you did previously as a repeatable playbook. And just kind of translate that into a new structure definitely helps to mitigate the risk when people are underwriting, anchor investing, or even just kind of being one of the early checks into a fund. What are some of the other things that you think has helped you and maybe your friends kind of, build that trust with the initial LPs? What are some of the characteristics?
Absolutely. So, and this has also been a journey, right? Like we like to internally, we think about like, hey, if you think about our pitch and our message a year ago versus what it is today, it has been an evolution. Some of it is based on feedback that we receive from LPs. Others are just the market's moving quickly, especially when you think about generative AI. And I think the things that are resonating are, while we are a fund one, people are not classifying us as emerging managers because we've done this at Qualcomm, at SoftBank, at M12. It is a fun one, but we're not new. So that definitely helps. The team has been together. I've known Nagaraj for 12 years. I've known Priya since 2017. So we have a long history together. That also makes a big difference. In the track record, there are some outlier returns, right? Like Series A investors in Zoom, Series B investors in Waze, Series A investors in Kahoot, which was a edtech firm out of Oslo, Norway. And all of the things that we're saying about we're investing around the world, we were willing to do things maybe that were a little bit contrarian at the time, but certainly panned out to be amazing outcomes. We have the proof points for this over the last 20 years. So that makes a big difference. We also have a more nuanced perspective on generative AI. We're not like saying, hey, we're a generative AI fund investing in startups that are building with Gen AI, so that's why you should put money to us. We're actually saying something very different, which is there is a lot of hype out there. And frankly, in many cases, the hype is somewhat out of control. And for us, we want to invest at the Series B stage because it's the right combination of there's some metrics, there's some defensibility, there's some way to underwrite an investment based on quantifiable metrics, but there's still enough pattern matching intuition that has to go into that. Sure, this company hit 3-4 million in ARR, but can they get to 10 to 20 to 30 to 40? That you still have to kind of place some bets on that's going to be possible. But ultimately, we are not going to be investing in companies that are lighting capital on fire, buying tons and tons of GPUs and doing, frontier models to compete with, whether it's OpenAI or with Anthropic or with big tech. I think early on when this was happening, we were saying this as in, we're not going to do this. More and more now you're starting to see some of the cracks that are appearing in terms of where is the hype gotten ahead of itself. Whether it's adept, whether it's inflection, whether it's rumors about character, you're starting to see signs that, hey, just spending this much money building very large clusters, and whether you're doing consumer or directly competing with the big guys, but you don't necessarily have a path to like generating meaningful amounts of revenue, there's going to be limited appetite at some point for investors. And so what we've said is we are interested in Series B, more verticalized applications. People that are building these task-specific models, but really nail the UI and the user experience for a particular B2B application. Ideally have a data flywheel with proprietary data that they can use to fine-tune their models, or maybe even build sub 10 billion parameter models on their own.
Yeah.
But you don't compromise on the things that you ultimately need, which is, can you reach the customers? Do you have distribution? Do you have attractive pricing? And do you have some kind of right to be able to say that you'll be able to defend and be successful? Defend your turf and be successful. And that tends to be more and more anchored in what kind of data advantage do you have. So that is starting to resonate. I think the other thing that we're saying is like, look, many of the LPs that we talk to are LPs in some of the most well-known and established funds. A lot of them have taken an approach to indexing the market. Right. So with every kind of layer of the Gen AI stack or every sector, we'll place a bet. Sometimes we'll have multiple bets. Our approach is, look, we're a Series B fund. It's going to be a concentrated portfolio of 13 to 15 bets. We are not doing a power law return model. We're not saying let's index the market. We are literally writing individual deals to a return outcome and with a risk tolerance in terms of if it doesn't work out, because it's going to be a concentrated portfolio. So if you're an LP and you're an investor in some of these big established funds that are indexing the market, that's great. You can also take a shot at a completely different strategy for a new, smaller fund like ourselves that's taking a concentrated portfolio approach for these verticalized applications where you have a data advantage and you have some right or privilege to be able to play in that industry. And it's not Gen AI is a hammer and everything is a nail.
Yeah, no, I totally agree.
As well. I think the last thing I'll say is just pricing discipline. Whether it was Qualcomm Ventures, whether it was M12, one of the things that I'm proud of is that there has been pricing discipline in terms of entry point, how we underwrite deals. Not everything is a SPAC, not everything is an IPO. All of the success we had in M12, frankly, was banked on M&A outcomes in kind of the 300 to 700, 800 million range. So if you think about Series B opportunities, we like to get in at no more than 150 post. 2 years ago, you would have said that's crazy. There's no good Series B deals that are that cheap. But I think things are starting to kind of come back to like, a bunch of people raised a lot of capital during the peak for their A rounds, and they have to come back to market. And they haven't grown into those valuations. It doesn't mean they're not good companies, but it does allow for more rational pricing to happen now than maybe a year ago or 2 years ago. And so
what's the revenue to valuation multiple that you kind of like to see as a benchmark, right? So you said around I think you said 150 in valuation. So what's the revenue that you're looking for at that valuation?
So we'll anchor and say, look, if you look at the best public market companies, software companies, they tend to get like a 10x multiple in terms of where they're performing. So you could say, fine, if you're Series B, obviously there's more potential for a lot more growth than a public company. But that's maybe the anchor data point you start with. Say, look, the best public market outcomes are 10x. So I want to work backward from there as to what's reasonable to give to you as a Series B company. We're not going to give you a 50x. We're not going to give you a 40x. We're not going to say, oh, you're at Series B going to get a 10x. It'll be more rational, anchored on that 10x in terms of what the public markets are paying.
Yeah, got it. So around like 10 to 12 million, something like that.
Around there is typically what we like to pay.
Yeah, that makes sense. What were some of the other disciplines? Because I think that's really great. I think that definitely helped me as a professional in the tech space. Because I mean, everybody comes from all walks of life, right? Some people just kind of went straight into venture. Some people built a lot of professional skills. some people were founders, right? So I had, kind of like you, I had corporate enterprise experience. So what were some of the things that you think helped build that discipline beyond just kind of like the constraints of the revenue and the multiple and the evaluation? I think for me, and just to kind of tee it off, I think for me, just kind of basic interpersonal skills, right? So email etiquette, best practices to BCC people at the right time. I know it's super basic and it seems like common sense, but we've probably both met people that have not developed those skills, right? Maybe 15 years in their career. So just some of the kind of professional, things. And one piece of feedback that I heard from an LP, which really stuck with me, is, when you're building a firm, these LPs expect the same level of professionalism that they get if they're logging into their JP Morgan Chase portal, in terms of the LP portal, the way that they're getting updates. There's almost like a customer service representative. It could be, maybe it's an analyst, but maybe it's someone who's handling portfolio ops. But, the level of professionalism should be the same expectation. No matter, I would say even no matter what level of sophistication the LP is, if you're managing money, you should pretend like you're Goldman Sachs or JP Morgan, because hopefully that's what you want to build at some point.
Yeah, no, that's a great point. So maybe I'll answer the first question about kind of what are like your point about interpersonal skills. So humility is absolutely key. And I think we both know it's not, you can't take that for granted in venture capital. There's a lot of big egos that are out there, but showing up with humility, being humble, knowing there's things you don't know, and ultimately how that gets instantiated is, how you show up as a board member, whether you're a board director or an observer. Mm-hmm. And so I can, I'm proud to say that, even after leaving M12, 2 companies in the M12 portfolio invited me to join as a common director because they valued my contributions at the board level, the board dynamic that I was a part of. And so I think that's probably the best testament to saying, hey, Samir as an investor was not just with the logo of M12 and Microsoft behind his back. It was Samir as an individual. M12 was the franchise he was associated with. But Samir as an investor is not just about that franchise that has longevity outside of that particular brand. So that's one. I think if you think about how we source and win deals today as a new fund, that is a critical piece. Founders doing reference checks on us, founders getting comfortable around whether it's Priya, Nagaraj, or Samir, what kind of board members are they? In fact, that was critical for how we won our first deal, Pixis. That was probably one of the big factors. I think the other piece that is a good testament, we have now 30 of our former founders as LPs in Turing. And this includes, Eric Wan from Zoom on, as maybe the one that everyone will know, but it includes a bunch of other founder CEOs that we've invested in the past. So that's a great source of validation and help for us. And then I think the last thing I'll say is, as we're fundraising and, obviously LPs do their diligence, we have consistently heard that when LPs get to the point where they're doing reference checks, and they're going and speaking with our portfolio companies and speaking with other founders in the ecosystem, we have consistently referenced extremely well in terms of how we've shown up.
Well, that's a baller move too, when they're doing references with investors in companies that you invested in. Those people are like, oh, I invested myself,
Right.
So right. I think that's definitely a great validation. And, I think that's, it's just a full circle ecosystem, right? This is what I've noticed from being on my 9th cohort of fund managers, right? So there's fund managers that eventually maybe just leave to maybe start a business. They may come back and be do well and be an LP. There's LPs that are family offices that are also raising a fund. So what gets kind of confusing, and sometimes it can be a little hairy, is there's 2 people that meet each other and then they're both pitching each other, right? There's a family office that's actually raising a fund. There's a fund to fund that's meeting the family office. The fund to fund is maybe thinking they're going to get it, so it gets kind of confusing where people are pitching each other. And I think that gets tough. But in your example, it's great. It's like, look, you know what? We not only were they a value-add investor, but we just love what they're doing. Samir's also a founder, right? He's building something. I back him as well. And just like he's backed me, I'm going to show up for him. So I'm proud. I'm a proud LP in Samir, right?
So. Yeah. And I think just personal story, one thing that I consistently heard from the CEOs that I have invested in is, and I take this as a positive, they're like, you're different than almost all other VCs that we talk to. And so tell me more. What is it? He's like, you deeply are passionate about the particular product or the space that we're in. There's a level of intellectual curiosity about it that, yes, it's the foundation is, hey, this is an investment and we want to see a return, but there's a deeper kind of passion about what's being built and why it's being built. Yeah. And I think that's appreciated by the founders. And I think it goes back to like, you know, I think to your point, which is, what do you bring to a company besides capital? What's the value that you're bringing, right? And for me, it's always been in product, in tech trends, in competitive simulation, competitive analysis, like, hey, what's going to happen to this competitor? Because that's going back to my own product planning, product management roots. And that's, you know, from an operational standpoint, that's where I think I probably lean in the most, is areas like that. And I think, you know, my belief is for the boards that I currently serve on, that is appreciated.
Let's do a lightning round of some additional advice to help these emerging managers. So I guess, what is maybe a question that managers should think about in fund one? And then, you know, how do those questions change, obviously, in fund two, right? There's probably, you know, more detailed DDQs and, you know, just much more rigorous diligence versus, you know, obviously fund one. But, you know, what are maybe some questions that maybe threw you off or kind of just you weren't prepared for that were helpful for you in growing, that maybe just would be helpful to just be aware of?
Yeah. So, I mean, there's a bunch of these. So I think team dynamic is one you should always be very prepared to answer. So I can tell you, one prospective LP put us on the spot over lunch, all three GPs sitting having lunch, and basically going from one to the next saying, what are the strengths and weaknesses of your other partners? Wow. And so you can imagine doing that live on the spot with all of your partners. Sure. You know, it's putting you on the spot. Yeah. But it's a test to see.
But hopefully you guys are doing that anyways all the time, right? Exactly. It's like, look, you know what, like, Samir, I'll be honest, you're not, you know, you're great at this stuff, but this is stuff that, like, you're not the expert on, you're not the Excel whiz, but I am, you know?
That's right. That's right. And I think it is an opportunity to basically represent maybe what you put in your pitch decks and the story that you're telling, but for someone to see that live interaction, that there is comfort in both you commending and not criticizing, but also calling out, you know, where the strengths are in the team and kind of where people are complement each other, you know, what you lean on one person to do versus another. I think that's something that managers should be prepared to answer. Another one that I think is important, and this one's a little bit more subtle, fund size. And this is more relevant to the fund two, fund three conversation. You should have a clear idea in your mind about what your strategy is going to be. Because a lot of times what you see is my fund's getting bigger and bigger because I raised 50, now I can raise 75, I can raise 100. Now, it's one thing when you're below kind of 500 million, you can certainly make things bigger. So, you know, for touring, our target's 300 million. But we're never going to be a $500 million fund, not fund two, not fund three. Maybe fund two is 350. But we have a strong belief that generally a fund size of this amount, and at the stage that we're investing in, that's where we're comfortable underwriting that we can return the fund. This is not about the touring GPs living off of management fees and just, you know, trying to figure out how to get wealthy off of management fees. It's truly being focused on returning the fund. And then you having a clear strategy on the size of fund that you want to deploy, that then you can promise to return to your LPs. So that's something you should have a good answer. Not to say that, you know, if you're a seed investor that, okay, fund one was 50 and fund two will be 75. There's nothing wrong with that, but you should be very clear and intentional about what your thoughts are on fund size increase or sidecar vehicles or opportunity funds you may want to do. And having a good answer on that is important because, as you and I both know, a lot of LPs are not looking at a one fund commitment. They're thinking about, you know, hey, we're committing to maybe 3 funds or more. So we want to have a long view on how these managers we're betting on will grow over time, or what their perspective is on what happens in the N+1, N+2 fund.
Yeah, no, I agree. I mean, they say your fund size is your strategy, and I got a couple examples, right? So I've seen both LPs, like emerging LPs, and a few GPs that are now on fund two, and their fund size is exactly the same. And, they're solo GPs. So they're like, look, I did well on fund one, and I'm just going to do the exact same thing. If that's what you're investing in, because this is kind of something that maybe solves a problem for what you're looking for, gives you access in a certain way that's been repeatable. And it's worked, and I'm going to do the same thing. And then I've seen other funds that are thinking about, the next level of institutional growth. So if they're doing that, there's things that could slip through the cracks, right? So maybe you've taken on or been able to achieve a larger, size of AUM, but then now you're spread too thin. You haven't been able to find the right staff to help you source and screen and deploy and handle portfolio support.
Sure.
So I think it's really kind of, when you're thinking about growing, I'm assuming, definitely speaking to how you're hiring and retaining talent, how you're developing talent, how you're building, how you're evolving your existing infrastructure, because maybe you're working with a specific type of fund admin and you've grown out of them. So, are any insights on that in terms of like, not the boring stuff, but like the back office, the infrastructure, and then how you guys are thinking about talent? Like, are you guys thinking about like a venture fellow program, a venture partner program?
No, great question. So let me start again with the last question about talent and hiring. So one of the recognitions that the touring team has had since we started to where we are today is a much deeper appreciation for the IR function. And, obviously if you're a solo GP doing, a small seed, pre-seed fund, it's a different lens that you put on IR. If you're you're doing Series B, you have some large institutional investors, you definitely have a different perspective on IR. And I think my learning is IR is not about just when you're actively fundraising. This is a continuous function around managing, growing, cultivating LP relationships, including ones that are not current investors in your fund. And this happens continuously. It's not just, of course, there's a burst when you're actually fundraising, but I think as important is what's happening when you're not fundraising in terms of managing those LPs. If they didn't come in fund one, maybe they'll come in fund two. And so keeping those relationships warm and alive and being able to understand how to segment the LP world and kind of the approach you take with certain kinds of family offices versus institutionals versus high net worth individuals, having someone dedicated to that role versus the GPs trying to do it themselves. Yeah. It's fine for fund one. You probably will do it yourself, but it's something you should pay attention to in terms of adding.
It's just like a startup, right? You're, in the beginning, you're a founder, you're doing founder-led sales.
That's right.
Then you hire a couple sales reps, right? And you're the sales manager, but then at some point you need to hire a sales manager to listen to the calls, support them, coach them, and point them in the right direction. So I would say the same thing. Like, the final question I have for you, because I know we got 2 minutes, what are your thoughts and where have you seen amongst your peers that specifically do growth equity? Where do they transition when they're kind of like looking at brokers that do cap raise intros versus hiring, a capital formation person that's done capital formation at TPG for the last 7 years? There's a certain, obviously the salary is different. And then you're probably going to hire like maybe an executive search person, but where should funds in terms of AUM or maturity kind of think about like those two kind of potential staff hires to just continue scaling the fund?
So on the kind of the, broker or agents, I think our learning, and I think some of us, some folks also gave us this advice. It doesn't make sense to start a fundraise with a placement agent broker. It's more helpful when you've made some significant progress and you can bring that person in to either help you finish the raise or make meaningfully, like, your third done or half done, they can get you to 2/3 versus out of the gate expecting them to kind of land you your anchor or your first set of, I think that's going to be based on relationships. So similarly, if you think about, hey, if you have access to a very talented capital formation person that has access to LPs and pools of capital, do whatever it takes to get that person because it will make your journey, I mean, not easier, but that much more like efficient to have someone like that that's, a part of the founding team originally. Yes, you have to figure out how to do the gymnastics to pay that person. Or, if they're a founding partner along with you, then hopefully there's a shared interest in the upside and you can, you don't have to anchor just on salary. But I think that, depending on where you are, if you're fund 2, fund 3, it's much easier to figure out how to fund a function like that than a fund 1. But if you have access to someone that is a credible capital formation individual with a network, highly recommend that, do whatever it takes to bring that person into the tent.
Yeah. Well, hey, Samir, this was amazing. The hour flew by, learned a lot. And this is how I like doing it, man. I just have a conversation with people and just go deep. So appreciate your time, appreciate the friendship, and we'll catch up soon.
Sounds good, Joel. It was
man.
fun, and have a good one.
Yeah, you too. Take care.
Okay.